Welcome back to Season 9 of Talking with Traders. We're into the 5th year of this podcast that began in 2020. Once again, IG have come on board as the sponsor of the podcast. We're truly grateful to have such a global leader in online trading as our sponsors. In the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some of these will be past guests that we invite back onto the show, and some will be new guests. The idea is to attract a broad spectrum of different perspectives from various players in different areas of the market. None of what you hear here is financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here to your own trading and investing. Remember to subscribe to this podcast on your favorite podcast app. That way, you'll be notified when new episodes are released. Or if you watch these interviews on YouTube, please subscribe to our YouTube channel and give us a thumbs up and leave a comment if you wish. We welcome the engagement. Once again, thank you to IG for sponsoring this podcast into its 5th year, and thank you listeners for your continued support. Now, let's get on to this week's interview. Welcome back to this week's episode of Talking with Traders. And this week we go to Panama City, where we find Laurens Bensdorp. He's a jet setter. I know he's only there for a short time before he jets off to Argentina. And we'll speak more about that travel schedule in a little bit. But Laurens is the founder of Trading Mastery School. He is an international best-selling author of 2 books, the most recent, which is Automated Stock Trading Systems. And before that, the 30-minute Stock Trader. And how I discovered you, Laurens, was that I interviewed your friend and colleague Tom Basso a few weeks ago. And after the interview, he and I were chatting, and he said to me, "Well, you know, if you really want to interview the expert on systems trading, you actually should speak to Laurens Bensdorp." And hence the introduction. And I'm very grateful for that introduction from Tom. And I'm very grateful because today we've got you on the line. So welcome to Talking with Traders.
Thank you for having me. It's a pleasure.
Good to speak to you, Laurens. So, quickly for an intro, I mean, you're a systematic trader. Obviously, you've written books about this, and we're going to talk about that. But for the benefit of an introduction, what got you into systematic trading as opposed to other forms of trading? You know, discretionary trading or quant trading. There are many ways of doing this. What drew you specifically to systematic trading?
I started with fundamental trading. I then tried day trading. I tried scalping. I tried all kinds of different things. Nothing worked for me. And the main reason that drew me into the systematic trading is that I can actually have a rule-based process that is completely automated, but also have it quantified so that I can actually have an idea of the strategies that I trade if they have an edge or not. Because if you trade some kind of strategy without knowing if you have an edge, the moment you start to lose money, you get very insecure. But if you have a systematic process, you know the back test, you know when it's supposed to make money, you know when it's supposed to lose money, then it is a lot more comfortable to actually consistently apply the rules of your strategy 100%.
Okay, very interesting. Now, I understand you're running quite a few systems. When I spoke to Tom Basso, he has 9 systems that he runs, but apparently you've got quite a few more than that you run.
That's correct. Yes, I trade currently a suite of 55 different systems. I think the main reason why I trade so many more systems is that I trade a lot more stocks than what Tom does. Tom doesn't trade stocks. He focuses more on ETFs and futures. And to my opinion, with stocks, there is definitely a lot more upside potential as well. But there's also more risk involved, of course, with corporate events and stuff like that. So that is one of the reasons why I say, okay, I like to spread it out as much as possible and place a lot of small bets, having sure that I have a lot of systems that do different things at different times. So I have a lot of different return streams trading at the same time.
Okay, fantastic. I'm going to ask you more about that stock specific element of your trading in a while because there's a few questions I've really been burning to ask you about that. But before we get there, these systems, right? You built them all yourself. Did you develop the software yourself, or do you use pre-built software to develop your systems?
No, the software that I use is in-house built, and it is specifically developed as well to to trade a large suite of multiple systems simultaneously. And the reason it was in-house built as well is that I didn't want to rely anymore on any retail software where there's always like kind of a possibility that maybe the software developer stops working with his product or whatever. I couldn't have like the own 100% control over it. Plus, I wanted to have it completely custom made according to my desires and my objectives. And that was the reason why eventually we moved over to a full automated solution that is 100% built in house.
Okay, very interesting. I mean, that must cost quite a lot of money to build a system like that yourself. But
Yeah.
what software do you, or what platform rather do you use? I know Python is a very common one, or C++. What do you
Yeah,
use?
Python would be too slow for me
Okay.
because you run large tests on large stock portfolios, and then in my case, 50 or 55 systems. But even if you would run one system with a basket of, let's say, 7,000 stocks, in Python, it would the test would run maybe 10 or 20 minutes or so. Way too slow, of course. We use C sharp, and there one test of going back 20 years on a stock portfolio of 7,000 stocks would take like 20 seconds, maybe.
Wow, that's amazing. Okay.
Yeah.
So, look, 55 systems is obviously clearly a lot of systems to be running, and no doubt why you automate it because no one could
Oh,
watch
yeah.
that that many systems all at once. But
No.
I would imagine there are times where some of these systems are not triggering any trade. Is that right, or are they all kind of
Oh,
firing all the time?
absolutely. Yeah. No, I mean, every system has its specific purpose and its specific objective. So when I'm in a big bull market, then of course my long-term trend following strategies, they're all long in the markets, but I have short trend following strategies as well that make money when the market goes down, but they would be flat at that time.
Right.
So it's not that all 55 strategies are all the time in the market. It kind of depends what the market tells me, and then the strategies will get executed, yes or no, depending on what the market is doing or what the specific stocks are doing.
Okay, all right. So, I mean, I'm guessing then this next question of mine is probably not an easy one to answer. I mean, I've got the question: how many positions do you typically have on at any one time? But I suppose that's market dependent then, right?
It's market dependent, yes, but I would say between 150 and 250 on average.
Wow. Okay. So a lot of open positions at any one time, and clearly
Yeah.
all at all quite small positions at any individual time.
And that could be long and short at the same time as well.
Okay. All right. Now, so all of these systems are completely automated. You know, even the execution. It's not just that it gives you the signal to go long or short, but actually the execution of the trades as well.
Yes, thank God. Thank God that part is automated as well because 55 strategies executing those manually, even if you would hire somebody to do that, what I did in about 15 years ago or something, the margin of human error is always there, of course. And so my process, my software spits out the orders basically, gives me a list of everything that needs to be bought and sold for that day. And then that connects to my brokerage platform, in this case, Interactive Brokers. And then the orders are placed automatically. Everything is done 100% on autopilot. I receive an email then with an execution report that everything is executed right. If there is an error somewhere, let's say, for example, that the data provider hasn't updated their data, so there is a data issue, then I will get an error message. And then I would need to take a look like, okay, is there something wrong? But what my software then does, it just tries to run the whole process 30 minutes after that again until it is correct.
Okay.
But that rarely happens. Those are like built-in contingencies for when something is not right. But 99 out of the 100 times, everything runs completely smooth on autopilot. Yeah.
Right. Okay. Amazing. So there's a lot of these adverts that traders, you see these guys trading off their laptop on the beach, and I've always said that's absolute garbage. It almost sounds like you've set it up so that you could pretty much be that person. And I know in the introduction I said that you're in Panama City at the moment, heading off to Argentina soon. And when we did the pre interview or the introduction call 2 weeks back, you were somewhere else, and in Portugal a bit before that. So it sounds like you're a jet setter and you're all over the place. Are you proving me wrong? Is my skepticism wrong that you could actually be trading off the beach based on these automated systems?
It's interesting. I actually prove you wrong with the sense that one needs to have a laptop on the beach, because I don't need to have a laptop on the beach because my platform is running on a remote server, and everything is done on the remote server basically. So I don't even need to have a laptop on the beach. I could go to the beach every day without anything, and everything is run automatically. It's good to have maybe a cell phone to see if everything is executed correctly. But as you said, I travel a lot, and my original residence is in Portugal. But sometimes I'm in an airplane and my trades are just executed automatically. So yes, it is possible to have that completely on autopilot and lay on the beach the whole day. To me, that would be a very boring activity to do. If I go to the beach after an hour, I'm kind of bored and don't know what else to do there. But it is certainly possible, yes, but no laptop needed.
Okay. Wow. All right. And you mentioned that these systems run on all different time frames. So what I'm curious about here is the sort of order of events, I guess, is lower time frames and higher time frames. I guess what I'm getting at is if you've got a lower time frame system that perhaps executes off an hourly chart, for example. I don't know whether you have these or not, but is it therefore then a requirement that certain higher time frame criteria are met? I hope I'm not butchering the question, but let's just say, for example, you've got a system that trades stocks on a long basis. It executes off an hourly chart, but it's long, and you're looking for a stock that trades above a short-term hourly moving average. Is it also then contingent that you need, for example, a daily moving average to be pointing upwards, or a stock be above a particular daily moving average? Are there those layers of criteria in each of the systems such that a short-term time frame needs to first meet the criteria on a higher time frame?
So not on all systems, but there are systems. For example, I don't trade based on intraday bars, only on end of day data. So before the market opens, I place all the orders. And then the next day, before the market opens, I place all the orders again. So intraday, there could be orders executed, but they're not based on 30-minute bars or something, all on 1 day bars. But I do have strategies that, for example, measure a pullback over the last 3 days, but use a longer term trend over the last 150 days, for example. Then they enter, and the same day they would exit on the close.
Okay.
So I do use some strategies that have those multiple time frames. I also use strategies that only use longer term time frames.
Okay. All right, very interesting. And what about risk? You mentioned that you can have anywhere between 150 and 250 open positions at any one time. So, I mean, of course, and the other question is, do you do this with leverage? Um, and what's the approach to risk? What do you typically allow yourself to lose on any one individual trade, or is that a dynamic number depending on volatility and depending on each individual system?
I mean, I do size it based on volatility, but of course, my individual sizing per position is incredibly small when you trade so many systems. So let's say for simplicity reasons, I have 25 systems that are trading long and 30 systems that are trading short. So that would equal 55 systems, right? So the 25 systems each trade 10 stocks, but I only have allocated 4% per strategy. And every strategy then only trades 10 stocks. Um, so my risk per trade per system is 2%. But then you need to divide that by 25 systems, but also 10 stocks. And that equals then to a 0.04 risk per trade. So the risk per trade is very small, but there are a lot of trades happening.
Okay, all right, that's very interesting. And have you got? Well, I presume you must have data going back and looking at the success rate of your systems overall. In terms of win rate, what percentage of your trades are winners and losers? And then also following on from that, have you got data on what's the size of winners relative to losers on average?
Really depends because I have a blend of systems that some systems are focusing on trend following,
Yeah,
where I might have a 30% win rate, but the average winning trade is five times versus the average losing trade.
yeah.
I also trade mean reversion systems where the average winning trade percentage maybe is 65% or something, but the average winning trade versus the average losing trade is one. So it really depends on the strategy that I trade, as I said, because there's so many different styles, different directions, different time frames in there, and it's kind of a blend of everything.
Okay, very, very interesting. All right. And have you found that certain of your systems are better suited to certain products? If you've got 55 systems and you're trading various different markets, I mean, I don't know how extensive your product suite is. Does it go to, commodity futures and currencies and bonds and equities and equity indices? We all know there's so much out there in the world that you could potentially trade. But I would imagine that certain systems are more suited to certain products. It's not necessarily a copy paste where one system that maybe works really well on S&P 500 also works on cocoa futures for just argument's sake. Is that a fair
Yeah,
comment?
I think one needs to be careful with that. Maybe some back tests will tell things like that. I think there's a distinction between stock and commodities like gold and crude oil. I think generally stock and commodities, they're suited for trend following. I don't see any exception in there at all. I would say mean reversion, using that for commodities, I'm not a big fan of it. You see sometimes those huge extended moves of commodities. Cocoa has a good example for that.
Mhm.
And you don't really want to sell an overbought contract on a commodity because they can continue to move up like crazy.
Yeah.
And sometimes that happens as well with individual stocks, but generally they have more of a mean reverting character. So in my case, stocks, I do mean reversion and trend following. Anything else, I focused a lot more on trend following only. And as long as there isn't a fundamental reason why a product couldn't trend, I trade it in a trend following style as well. And a perfect example of that, and a trap sometimes, is actually cocoa. So if you go back 1 year or 1.5 years from now, you'd see like a very long period of time where cocoa wasn't doing a lot, basically.
Mm.
So let's say you had a back test of 10 or 15 years or so on cocoa, and you ran another 20 or 30 commodities, and you saw that, okay, cocoa never made any good return, so I skipped that from the portfolio. That's the worst thing that you want to do, because is there a fundamental reason why cocoa could not be trending? No, it's exactly you want to run for those outliers. You want to hunt for those. And therefore, as far as trend following, as long as there's not a good reason that something could trend, um, I have it in my portfolio and I trade it.
Okay. All right. Super. Now, you mentioned that you trade stocks as well, and that was something that Tom Bosser doesn't do. He's more futures and index and ETFs. So that for me is interesting, and why I find it interesting is because the stocks are more volatile, and as you alluded to earlier, you said they can, they come with potentially higher reward, but also then higher risk as well. What I'm asking about is slippage, because I've been trading in, especially lately, it just feels to me more and more like the movements in stocks. It sometimes is like Russian roulette, especially around earnings time, and we're right smack bang in the middle of US earnings season at the moment. And literally, I see stocks that are, on a certain day, some stocks are up 30, 40% on the back of an earnings release. And then at the same time, I look at stocks that have got bullish chart patterns, bullish trends, bullish everything, and yet they can open the session down 15 or 20 or 25%. I mean, these moves are enormous. So how do you mitigate that kind of slippage in your system? Do you trade over earnings releases, or do you try and just not be involved over earnings?
I love earnings. I think that um, often in the earnings seasons, you see a move of a stock going one way and then going the other way, basically. Very often, mean reversion systems can do incredibly well when there is an earnings seasons. But also trend following can do incredibly well during those times. It is those moves actually that I think there's an edge in there. But if you trade them not on a systematic way, but discretionary, and you look at your screen, yes, then it can get very overwhelming to trade those things because you see them all over the place. And I do not necessarily want to short stocks that have a huge amount of volatility. Like I tend to filter out stocks that have like an average true range percent. So of more than 20 or 25%, because there's just too much volatility in there. And I don't think that there is a good indication then that an indicator like an RSI could have any good of a predictive value. There's often something else going on over there. So I kind of want to filter out a little bit of the crap. But on the other hand, I do like to embrace the fact that there is that volatility. And one could also and always adjust your positions for volatility, of course. But I love the earnings seasons actually, and I think the whole key is when you trade systematically, you don't need to look at it. I mean, I don't really know when the earnings season is there what stock will be coming out after the market close with their earnings or profit or loss or whatever. I have no clue. Neither do I want to know, because I have my back tested returns. I know that there is a statistical likelihood that there is a big edge in trading the way that I do. So it is my task to let things just run as they are and don't touch it.
Okay, interesting. Uh, You've been trading for a long time, so I guess I can ask you this. Have you found that the market has become more volatile around earnings now than what it used to be in the past? I mean, my career is not as long as yours in the market, but I don't remember seeing, such enormous moves over earnings as what we do now, where you get stocks that move 20, 30, 40% quite as often as they do now in terms of gaps up and gaps down. Or am I wrong on that?
Um, I think if there's one thing that I have seen is and I don't know if it relates to the earnings season, because as I said, I don't follow that really. But I have seen that there's more corporate risk, there's more corporate events involved. And I actually wrote about this in my second book, which was written in 2019, released in 2020. And I said, be careful for corporate risk, especially on the short side. I think since that time, I've seen more corporate risk and more corporate irrational events that I've ever seen. Um, so that is something that I've noticed. I mean, we've seen the whole thing with the meme stocks, for example, when GameStop was moving up like crazy. And to me, it doesn't really matter that much. But yes, I have seen more uh, weird stuff going on in there. But I bet there have been times like in the dot-com boom market, 1995 to 2000, but also the bust after that. There were huge moves as well. So I think it goes in cycles when that is the case. 2008 was very volatile in a bear market, for example, but then you had more quiet times as well. But yeah, so it could be that there is a little bit more corporate risk right now, but it could be that there will be times again when that is more quiet as well.
Okay. All right. Super. And what about drawdowns, Lawrence? I mean, every everybody goes through ups and downs, and no doubt even your systems have their good periods and bad periods. What do
Absolutely.
you do? You, for example, do any technical analysis on your P&L curve? This is something I've seen some systematic traders do, where they'll put a trend line on the P&L curve, and when the P&L curve breaks below a rising trend, they kind of look at it and say, okay, well, my system's clearly not optimized for this kind of a market, so back off a little bit. What do you do? First of all, do you do any of that type of analysis on your profit and loss curve? And secondly, when it comes to drawdowns, how do you deal with that?
So as far as an equity curve on my P&L curve, no, I don't do that because I think if you have enough confidence in your system, um, the moment where you make a decision based on the slope of your equity curve and turning it off, you kind of make a prediction that from that time on it won't work anymore.
Right.
And it could exactly be at the wrong time. So if I don't see that there is fundamentally anything wrong with my system, I accept the fact that I will have drawdowns. I accept the fact that there will be times when the system is not working. That doesn't mean that it's not broken. So you don't want to try to fix something if it isn't broken. So I just my thing, uh, let it do its thing and don't interfere with it, and making sure that you have a position sizing that is sized in such a way that it deals with your personal risk tolerance. And your risk tolerance is different than mine. And everybody has a different risk tolerance. And you want to make sure that you stay within that risk tolerance. So I always say that if I see a 10% maximum tested drawdown in my suite of systems, I expect double of that in my live trading
Okay.
without even having to doubt that anything is wrong with my system. So, and that's where the drawdowns come in. Um, as traders, we need to embrace drawdowns. If we don't have drawdown, we can't make money. The thought that some people have that they're a day trader, that they start in the morning, half an hour trading when the market is opening and 9 out of 10 days they're making money. Doesn't really work like that. It looks wonderful, but it doesn't really work like that. There's times where it's just not working, but you're risking money. When you're risking money, you need to embrace that risk, because the amount of risk is also defining the possible amount of return that you can have.
Yeah.
So the drawdowns are part of it, and it can be very annoying when you're in a longer drawdown than expected. But as long as you can control the magnitude of that drawdown, then you can deal with those drawdowns in a lot easier, more comfortable way. So, for example, my systematic trading journey started in 2007 when I was trading 4 systems, 2 long and 2 short. I had a lot less equity than I have right now, and my drawdown tolerance was a lot higher. I mean, I could stand drawdowns a lot larger than what I can deal with right now as far as a percentage. And although it shouldn't matter, still, if you take a look at the dollar magnitude and you start to get older, you start to get more of a approach of wealth preservation instead of only focusing on accumulation, then you say like, well, if I aim to get a 15% compounded annual growth rate per year, I still double my money every 4.8 years. That's, to me, is a pretty good deal, especially if my drawdowns stay below 10%, which is my aim. And that is a very comfortable place to be. So I'm fairly conservative. My recommendation is that most traders that are a little bit older should be conservative as well, because what you see so often is that they get a drawdown that is too large that they can psychologically handle. It could be the difference of being able to live off your trading and be in retirement versus having sized your position too aggressively, and suddenly when you're 65 years old, you need to find a job to get some extra income because you can't live off your trading anymore. And that mainly is because you step out and suspend all your systems at what time? At the worst possible time, where you can't handle the dollar amount anymore that you've lost.
Okay. Very, very interesting. So, yeah, wind the risk down as you get older. And is that your aim, 15% per annum compounded? I mean, you threw that number out there. Do you have, are you at liberty to say what your sort of long-term compounded growth rate has been over the, let's say, the last 10 to 15 years that you've been doing this?
Over the last 10, 15 years, it's probably around that. I don't I think it's hard to compare the way how I traded back in 2007 versus the way how I trade right now, because I trade so many more systems. And I think 2007, 2008, and 2009 were incredibly good years. I've had some rougher years as well, like 2019 for me didn't work out that well. The last 2 years have been very good as well. For example, 2022, I was positive as well. So generally, yeah, I would say, I mean, I don't track it that precise. I am fortunate enough to not having the need to present my quarterly returns to investors or anything because I don't run a fund. And if I see my account is increasing in size, that to me is basically the most important part.
Yeah. Do you only trade your own capital, or do you have some private investors that you trade on behalf of as well, or not?
100% my own capital. I
Oh,
used to manage money.
yeah.
I never got very big in managing money. I think it's one thing to have a very good trading system. Another thing is, as a money manager, you need to be able to raise capital. You need to deal a lot with all the legal framework, accountants, lawyers, and everything, compliance officers, and stuff like that. And that is a part that I am not interested at all, because that moves way too much to the corporate world. I am invested, though, as a shareholder in a U.S. mutual fund that currently manages more than $1 billion. But that is completely passive. I don't do anything in that, and I kind of like it that way. I most likely would have had a high net or a net worth that would have been a lot higher would have been a hedge fund manager over the last 10 years. But the price to pay for that and the level of stress that goes paired to that is not in line with my life mission.
Yeah, it's so interesting you say that because it takes me back to the interview that I did with Tom Basso a few weeks back, and he also just in talking to him, it sounded like he was very happy to eventually walk away from the business of managing other people's money for all of the reasons that you've mentioned, and it's a lot less onerous when it comes to managing your own capital and not having to answer to other people and manage their expectations as well.
Yeah, and Tom is the main reason why I quit my managing money, basically, because he told me all those things that he didn't like about it at all. And I don't have a background at all in corporate world. So when I heard that, I was like, nah, I don't really like that. So I had a couple of Swiss family offices that I was trading for, and I continued doing that for a while. But eventually, I said, okay, I'm just going to stop with that. I don't like to get phone calls at 8 o'clock in the evening when I'm having a nice dinner and with a question why their account is down 2% and the market is up 2%. It's not what I want.
Yeah.
There are many people that are very good at that part, or they can hire staff for that. It's not my thing. It's not what I like.
Right. Okay. Super. M- Lawrence, deviating a little bit now, but many amateur traders are awed by these trading competitions that we see advertised, and they get a lot of traction these days. And you see, yeah, traders that enter, like the US Investing Championship, and these guys come out with annualized returns of, sometimes hundreds of percent. I think it was Oliver Cull who did over 900% in a year. I mean, it's phenomenal, right? We can't deny it, and these things are audited, so it's real and what have you. But my personal feeling on this is that these things are interesting, but they're actually very unhelpful in terms of what they portray about trading. Because yeah, and I'd like to get your opinion on this. You're someone who does this professionally. You've spent a lot of money building systems. You understand risk. You've made this your profession, and you clearly do it sustainably and successfully. But what are your opinions on these types of trading contests? Do you share my view that they're generally unhelpful in terms of portraying trading in a sustainable light, or not?
I do. I share your view 100%. I don't want to say that there isn't any skill available in those trading contests, but it's basically the story of the law of the big numbers.
Mm.
If 10,000 people are participating in a contest like that, and two or three of them show like an excessive and phenomenal return, people then get kind of geared into that thought like, wow, so you can actually make 900%. No, that's an outlier. There are people that maybe have made those returns, but you don't see them in the other years, also on the top, where they maybe were down 75 or 80%. So it's the law of the big numbers where a few of them made a huge amount, and then I think most people have kind of a tendency that they want to get rich quick.
Mm.
So they see those numbers, and then they see that, okay, with futures and with Forex, you can have all those leverage. So you could actually trade that, and then in 2 years, you can retire.
Yeah.
But we never hear about the 99.9 or 99.5% of all the other traders that actually blew up their account.
Mm.
So it's such a tiny part of it. And again, there are some people in there that definitely know what they're doing, but they're not on that list every year either. So you don't see their drawdowns either.
Mm.
And even if they maybe can deal with those drawdowns. Normal people can't. I mean, the Turtles program back in the 80s is a very good example as well. They got very famous because they made so much money. But do you know what their drawdown was?
No, what was it?
Their max drawdown was in the 70s.
Wow.
So, and that's what you can have with futures. But if you continue to leveraging up, then you can climb out of that drawdown. And although you need to make like 300 or 400% to get back to break even, but it's possible. But that's why they could show like those 100% plus returns or so. But it was also during a time period where the markets were very favorable for that kind of trend following style. So, yeah, as far as trading competitions, it's atypical if you see a few people there that have huge returns, and that you think that you can do that as well.
Yeah. Okay. Great answer. And I suppose that a similar light, but a little different, is that the trading systems. There are so many trading systems out there advertised where you've got some guy who's supposedly built a system, and they try and sell the system, and yeah, you're someone who's done it properly. You've spent a lot of money, a lot of time back testing systems, building systems. Whenever I see these systems for sale on the internet, I'm always of the thought, well, why would you sell it if it's so good and it makes money consistently all the time? Why would you want to sell a system like that? Why don't you just trade it and keep it private, keep it to yourself? So you're a guy that's really gone the hard taken the hard yards and done it properly. So again, your thoughts on these types of trading systems that are advertised on the internet, where you can pick them up for a couple of $100 and supposedly plug it in and plug and play, and away you go. You're going to start making money. It's hogwash, in my opinion. Yours?
First thing is, if you buy a trading system, um, the first thing is it's not your brainchild.
Yeah.
You haven't created it. So the moment when it's not starting, let's assume that it's a good trading system. Let's start with the good part. Let's start some with a positive part, that it is actually a system that is solid. People then need to replicate it. Then most likely the first thing they will do is they're going to tweak it, because they look at the rules and they don't really like it that much. So they eventually end up with something that is completely different already. But also, if you want to follow it, and you haven't created it yourself, the moment that system starts to get into a drawdown, you will abandon it because you don't understand why it's losing money.
Yeah.
So therefore, let's say for the ones that are good, I think at best it could be a guideline of what you could use as a framework for yourself to develop something that suits your personality. So I often give webinars and release complete trading systems, one long system, one short system. I review all the rules, show the back tested returns and everything. And I give those for free. I don't charge money for it. And I think that is a good help for people to understand what the components are of a system according to the objective that you set out. Then, of course, you have people that have a certain software. They hit the optimize button. They come up with a phenomenal return, a system that makes 100% per year with a maximum drawdown of 5% total, and they sell that then. That, of course, is not something that is legit. That is basically knowing that you sell something that has a large likelihood to not perform to even close in the future. And that is something that I'd say is not helpful at all. But so if you have something that you can use as a framework, at least, I think that can be useful. I don't want to sell them because I think that eventually people end up with something anyway that will morely suit their personality, their style. So they're going to tweak it anyway, but most likely end up something then which suits their profile a lot more. So using it as a template can be good.
Okay. All right. Lovely answers. Well, Laurens, we've come to the end of our allotted time, so I'm going to wrap up this interview. It's actually really been interesting speaking to you and very enjoyable.
Likewise.
I feel like we could keep talking, but we have run out of time now. Last thing is, where can the listeners to this podcast follow your work? Obviously, you've got your two books, which I'll give the names again. One is Automated Stock Trading Systems by Laurens Bensdorp. That was the one that you wrote most recently and released in 2020. And then before that, the 30-minute stock trader. Where else can listeners to this podcast follow your work?
I would recommend to go to tradingsystems.com. And there you can see what my company is about. We do offer on a very low scale some mentoring to people who are very serious about trading as well. You can find more information over there. You can see a demo as well of the software that is available only for my mentoring students. So it's not a retail software, but it is the same software that I use myself, which we provide for the mentoring students. So that's where they can take a look as well. And there's the link of my two books as well. And in the beginning of 2025, there will be released a new book as well based on retirement accounts. I don't know the title yet, but as soon as I know more about that, it will be published on tradingsystems.com as well.
Oh, excellent. I look forward to looking at that one and reading that as well. Super. Well, Laurens, thank you so much for your time. I know you're heading off to Argentina shortly on your travels. Enjoy. And once again, thank you. And I hope we can keep in touch.
Absolutely. Thank you for having me. I think those were great questions. And for anybody else, just reach out if you have any question or anything. And thank you very much.
Thanks for joining us for this week's episode of Talking with Traders, sponsored by IG, a world-leading CFD provider. We really are privileged to have such a strong global provider of online trading services as our backer for this podcast series. Remember to subscribe for more episodes by clicking on the subscribe button of your favorite podcast app, or if you're watching on YouTube, please subscribe to our YouTube channel, give us a thumbs up and leave a comment. We welcome the engagement. Till next time.